A reverse mortgage is a loan secured against the value of your home that allows access to your home equity. It turns some of your equity into tax-free cash without the requirement of monthly mortgage payments. Unlike a traditional mortgage, you will not need to make any principal or interest payments until you and your spouse leave the home. Interest accumulates over the life of the mortgage, and the total mortgage principal and interest will be due when you choose to move or when the house is sold. This mortgage is designed exclusively for homeowners aged 55 years and older. The funds from a reverse mortgage can be used for whatever purpose you choose: to cover monthly expenses, renovate your home, pay off debt, or travel. The choice is yours. With a reverse mortgage, you maintain ownership of your home, and there are no monthly mortgage payments required. Repayment of the loan is only required once. The bank guarantees that the amount you eventually repay will never exceed the fair market value of your home. And if your home goes up in value, the appreciation is all yours. You're simply required to maintain your property and pay the taxes and insurance. A reverse mortgage provides income that people can tap into for their retirement. One advantage of a reverse mortgage is the borrower's credit may not be relevant and is often unchecked because the borrower does not need to make any payments. Because the home serves as collateral, the mortgage must be repaid along with accumulated interest when you choose to move or when the house is sold. In some cases, the heirs may have the option of repaying the mortgage without selling the home. These types of mortgages have large origination costs relative to other types of mortgages. Borrowers with good credit should carefully analyze the options of an all-in-one mortgage and compare them with a reverse mortgage. Most Canadians are heading toward reverse mortgages, and on the surface, reverse mortgages seem like an ideal solution for cash-strapped seniors. They retire and end up remortgaging their home with a reverse mortgage in order to access the equity in their home. This is not necessarily a bad thing. As a matter of fact, it's a great way to utilize the equity in your home that's built up over time through paying off your mortgage as well as capital appreciation in your home. For a lot of people, myself included, the idea of selling their home, downsizing, and accessing any excess equity to support their retirement income is not an attractive option. They don't want to leave their home for any number of reasons. Maybe they like where they're living. It's close to friends, family, or their church. It's a familiar community, and they don't want their lifestyle disrupted. For most people, their home is their largest investment. Well, why not treat the equity in their home as an investment and live on the funds available just like any other investment? If you have investments in a TFSA or an RRSP, you would happily live off them in retirement. You should also feel comfortable living off the investment in the equity of your home. Unlike other investments where you're comparing the return on the investment over time, you need to compare the total cost of accessing the equity in your home. For example, I look at two comparable investments when I want to look at their respective earnings over time, and perhaps one investment will earn 6%, while a comparable investment will earn 9%. Well, I can then make an informed decision as to where I choose to invest. The higher return will benefit me over time, but when comparing reverse mortgages, the opposite is true. You want to compare the costs associated with the different mortgages. For example, what are the costs to set the mortgage up? You have appraisals, legal fees, interest charged. Well, let's compare a few of the many differences between the all-in-one mortgage with a typical reverse mortgage. Well, the cost to set up a mortgage in the all-in-one are nil. The bank pays the appraisal and legal fees. The reverse mortgage could cost you from $2,000 to $3,000. That includes the appraisal, legal fees, and closing costs that are all paid for by the borrower. The interest rate charged, well, the all-in-one mortgage is typically 2 to 3% lower than reverse mortgages. The credit limit, the all-in-one mortgage may be available up to 80% of the appraised value of your home, although typically 50 to 60% is where people aim for. The reverse mortgage usually can be 10 to 40% of the appraised value, up to a total of 55 in qualifying circumstances. And the initial amount required to borrow, the all-in-one is none. You only access the mortgage when funds are required. The reverse mortgage, usually $25,000 to begin with, and then smaller increments after the initial borrowing. And there's also penalties for paying off the mortgage earlier. Not so with the all-in-one mortgage. Interest penalties for reverse mortgage could be quite high. And it must rank first on the home's title. Any other debts secured by the property have to be retired with proceeds from the reverse mortgage. And they must be moved into second position. And that may entail additional costs. Where an all-in-one mortgage may be placed into second position. In both cases, there's no required monthly payments, and interest is added to the borrowings at the end of each month. As the all-in-one mortgage is considerably cheaper to establish, has a lower interest rate, and is much more flexible than a reverse mortgage, it only makes sense to look into both types of mortgages before committing to either one. Check out some of my other videos, and if you found this video beneficial, please consider subscribing to my channel and hit the like button. Thank you for watching.